Hello and welcome to the Small Business Briefing. I'm Brian Calley, CEO of the Small Business Association of Michigan.
Hi, everyone. Thanks for tuning in today. I'm Sarah Miller, Vice President of Operations at SBAM. I want to welcome one of our new winners. This is another Michigan Celebrates Small Business 50 Companies to Watch winner from 2025, Envision Automation. They are an elite member, so welcome to owner David Strickland and team. All right, so Brian, last week we did talk about the One Big Beautiful Bill Act, but you've created an additional summary write-up that we're going to share, and I know you want to go through a few of those finer points today.
Yeah, there's a summary that we put together. It's on the website. We share the link with you there so you can take a look at it. Now, keep in mind this is a massive bill, and they say one big beautiful bill. It's certainly big, got a lot of pieces to it, and so this article is not going to be a substitute for your whoever prepares your taxes to really know your situation and what's the most relevant. But what I tried to do is to pull out the things that were most universally or most likely to be relevant, aside from the obvious things like the rates didn't change. So the rates from the bill that passed back in 2017 are continued on into the future. So there was some discussion on some additional changes. None of those happened. So what I did in this article is separated out the individual tax return changes from the business treatment, and just knowing that there's a lot of interplay for small businesses between the business's finances and your personal taxes, especially for pass-throughs. So standard deduction is increased. We put the numbers in there, but 15,750. So if you don't, for an individual, 23,625 for head of household and 31,500 for joint filers. So if you don't itemize the standard deductions, which are pretty big, are going up even more. But what I think is going to be really important for small business owners is the state and local tax deduction. More of you, even if you don't, maybe you haven't in the last couple of years itemized because that standard deduction is so big. The fact that the state and local tax, the SALT, S-A-L-T, state and local tax deduction, that cap, before you could only deduct up to $10,000. Well, for many of you, your property taxes alone are are out of that, but you put on top are above that, but your state income tax at 4.25% as well. There was probably a lot of state and local tax deduction that you couldn't claim before because of that $10,000 cap. For the next few years, it will be at least for the next few years. In fact, what was it? Yeah, through 2029, the state and local tax deduction will be increased to up to $40,000. So I think that many more people will, especially business owners, will benefit from that. Um, Child tax credit is increasing, including the refundable portion. So for your employees, between the state and local tax increase, or I'm sorry, the standard deduction going up, the child tax credit going up, workers with kids, even upwards around, it'll probably be around $80,000 or so before somebody has a tax liability, a federal tax liability. Of course, not everybody pays Social Security, everybody pays Medicare. But in terms of just the regular income tax, I think income levels of 80,000 or more is when people are going to start paying taxes. Um, Also, there are two categories of income now for some of your workers that will not be subject to income tax. First is overtime. So now, if you pay voluntary overtime to people that is not required under the law, then that wouldn't count in this category. There'll be some changes you'll have to make to the W-2 forms, and the forms will be adjusted to account for this. But overtime wages up to $25,000 will be tax free under this bill. So that's 12,500 for a single and up to 25,000 for joint filers. So the W-2 will have to separate out these things going forward. Your regular wages and then the wages um, that are overtime and that is overtime according to the Fair Labor Standards Act, the FLSA. So there was some misunderstanding I saw on this point that I wanted to point out. I read some articles where it said it only applied to mandatory overtime, and some people took that to mean like, what if the employer requires the employee as a condition of their employment to work overtime? Like sometimes police officers need to or are subject to mandatory overtime. That is not what this is talking about. What this is talking about is under the Fair Labor Standards Act, if people work over a certain amount of hours, you must pay them time and a half. That's the mandatory overtime that you're reading about. So it applies to all overtime that you're required to pay under the Fair Labor Standards Act. And then tipped wage income deduction. This is another one. So for our bars and restaurants or um, places that have valet services, salons, that sort of place that fall under the feds have a list of the tipped wage professions in the tipped wage income. So in other words, also having an accountant work on tips doesn't get you out of taxes. Okay, there's a predetermined list of professions that are tipped wage professions, but but mainly we're talking about bars and restaurants and personal services like hair salons. The in those cases, only cash tips that are reported are tax-free under this proposal. So obviously, the tips that aren't reported can't be deducted because there's nothing to deduct them to because they weren't reported. Okay, so, but the idea behind it applying only to cash and not those that are paid by electronic form, Venmo uh, or credit card paid by credit card. In those cases, all that income is automatically reported. It has to be, and it's captured in the electronic system. That So this is really a tax deduction just to try to capture more uh, of uh, of what's happening with unreported or cash tips. So essentially an incentive to go ahead and report the tipped income, and um, and then you won't have taxes on it. But the issue is there's other types of taxes. Some cities have income taxes, the state has income taxes. So when you report it, those workers might be a little less interested in reporting it because they might still come out behind because of the state and local taxes. Anyway, everybody should be reporting income that they receive in the first place. Those are the top changes on the personal taxes, and then that I think are most kind of universally relevant. The and small businesses, we talked last week about the 20% deduction for business owners, the QBI or qualified business income. That was made permanent and it was expanded to include professions that were previously left out. Then there's a series of changes on on depreciation. So you get to essentially expense more earlier when you make capital investments. So there's a few different categories or three different categories of that I don't want to try to get into right now, and I'm not an expert on it, but to the extent that you're making capital investments or you're planning to make capital investments, they definitely have made tax-wise it worth your while um, to do it earlier than later. It's meant to be a stimulus. It's the whole purpose behind it. And then there's a more generous business interest deduction. So when you pay interest, if you borrow money and you pay interest, there's limits on how much you can deduct. Those limits are made more generous, and then you can essentially expense research and development costs more quickly under this proposal as well. And because these changes were essentially retroactive, not technically retroactive, but you can refile previous years, or for some companies in certain categories, you get catch-up deductions in the next in your next couple tax returns. So those are all changes that are worth your while to get to the bottom of. We have that article that you can take a look at and see what you think might apply to you. But I would encourage you to reach out to your whoever handles your tax returns and just get a sense for, hey, does it make sense for us to go back and redo some other tax returns or anything different we should do right now? I'm thinking about making some investments. Is now the right time? Do I qualify for this accelerated depreciation? Those types of questions, I think, are worth asking because some of these changes are pretty big.
All right, Brian. Well, thanks for that update. And we are working to try to put together a webinar too, so stay tuned for information on that. All right, so SBAM is part of a business coalition that is working to fight off some prejudicial language in a ballot initiative that would institute a graduated income tax. And last week we had a big win. So, Brian, tell us a little bit about what happened and what's next.
We are really concerned about this effort to amend the Michigan Constitution to implement a graduated income tax. And this has to happen by referendum. So it would go up for a public vote. And the part of the process that we're working on right now is what are the words? What's the summary of this very complex and long proposal? What's the 100-word summary that voters will see when they're voting on it? And of course, if that language is prejudicial, it can predetermine the outcome of the proposal. Now, keep in mind, proponents still have to collect hundreds of thousands of signatures. Um, the total amount that they need to collect are 4,000. It's a percentage of the people that voted in the last general election. 446,198 valid signatures. Now the key is valid signatures, and so normally you need to collect somewhere around 6 or 7 or even 800,000 signatures to be sure that you had enough valid signatures collected. But in any event, that proposal was moving forward. The Board of Canvassers had looked at some language and actually approved some language that we were kind of disappointed in the outcome. But then it turned out that proponents, those who were proposing this law, this change in the Constitution, they made a change to their own proposal. They refiled a new proposal, and there wasn't the proper lawful public hearing on the changes in the proposal, kind of a bait and switch. They put it in one way, there was public input, then they made some changes, and then the summary was approved. Well, it seems that maybe the Board of Canvassers wasn't aware that that proponents had changed their proposal. They needed to start the process over. So that's the win. It's just a temporary win, but at least the process has to start over. We're waiting still to hear when they're going to hold another meeting, and we're going to advocate for more fair language at that time. So we're hoping they don't just reapprove the same language as before. Before it was quite rushed. They look at 3 different proposals on the same day. They ran out of time and very clearly rushed through this last one, which frankly is the most consequential for small business owners. They rushed through without giving it what we thought was due consideration and debate on what the proper words should be. So we're hopeful that they will revisit the words that are approved as opposed to simply doing a public hearing and approving the same prejudicial words that they looked at before. So stay tuned on that. This is one that we are going to be following very closely and actively engaged in.
So there was an op-ed published in the Detroit News about the ramifications of such a proposal. So are there experiences in other states that kind of tell us what we might expect?
There's a couple of different data sets that you can look at independently to get an idea of what would happen. What should we expect in Michigan if this were to pass? And proponents are saying, hey, it's just going to increase spending in public education. I don't know if you've looked at budgets in the last 10 years, but public education is one of the biggest winners in the state's increases in revenue have gone to public education more than anything else. And so but what proponents are saying is, hey, look, if you tax the rich, as they say, and then you put more into public education. If we look at other states, first off is that states that have seen um, big increases in their or big improvements in their public education system, that there's not, or those who have high outcomes, there's not this correlation between just throwing money at something and seeing better outcomes. As you might imagine, business owners know this. You can't do the same thing, just spend more on the same thing and have different outcomes. You just have the same outcome at a higher price tag. That's our first big issue with this proposal is that it doesn't actually say anything about outcomes in education. Just simply would make the current system more expensive. But there's two data sets that I think really are important here. One is population, where is population coming from and moving to, and which states have are high cost and which ones are not. And this proposal would make Michigan in the top 10 highest cost states if it were to pass. So we would definitely be a high cost state if this were to pass. The if you look at just the three highest tax states, those would be California, New York, and Illinois between 2020 and 2023. Looking back at the census data during those, um, there were nearly 3 million Americans that moved out of those states. That's net. And where did they go? Well, the most common places that they went, which by the way, Michigan tracks this pretty closely, especially Florida, Texas, Florida, and Tennessee. That's where people are going. Those coincidentally are low tax states. So those are some anecdotal examples. But if you look at the total, high versus low cost, and then compare it to population movements, you'll see that of the 32 states whose overall tax burdens per capita were below the national average. So the 32 states that are below the national average um, experienced more, just a net increase, more people moving in than moving out. So a net increase in population based on migration. You got other dynamics in terms of, how many people are born and how many people die every year, but just talking about net migration here, which is the most important component when it comes to this analysis about tax rates, because it'd be working age individuals, the not babies and not retired people. The so the 24 out of 32 had net plus. Of the 18 states that are above the national average, 14 of them experienced net outbound migration. So you see in both cases really a strong correlation between where people live and where people and where the cost of living is higher. And of course, we've seen that here in Michigan, net outbound migration, and this is particularly from state to state. So we've had positive when it comes from international immigration, but net losses when it comes to migration between states. And Florida is who we regularly lose the most to. So I think it behooves us to really look closely or consider carefully a proposal like this that says, hey, that people at higher incomes should pay literally more than double. They're talking about taking it from 4.25% to 9.25%, making it top 10 most expensive. We're not going to capture the growth in the future with that. These are some of the most prolific job creators in anywhere in the country, and certainly here in our state. And chasing them away is not a good economic strategy. So we are hopeful that we'll get fair language that is not prejudicial, and then we'll make the case to the voters of the state of Michigan on why this is a bad idea.
All right, well, thanks for that update. So last week, Brian, you said that the chances of an interest rate cut this year were likely waning because we had another positive jobs report. But it sounds like now you kind of have a caveat to that.
Yeah, the caveat comes from just the Federal Reserve Board of Directors itself. So they released the minutes to their last meeting. So a lot of times we hear just from the chair, or I report on what the chair says, And I kind of felt like they were kind of downplaying Jerome Powell was downplaying the possibility of a rate cut. But if you look at each of the directors on the board, there's it still seems like they want rate cuts this year or anticipating it. The caveat being that the trade deals need to be settled. That's the one thing is, is there going to be supply chain disruptions? And of course, constricted supply means increased costs. Um, are there those sorts of changes that are big question marks still that are in the way of the Fed's maybe pulling back and easing monetary policy a bit? And so the fact that there's still enough of the Federal Reserve Board that are thinking this way, I think makes it more likely. I still think that the ball is in the president's court, though. Um, the trade and the tariff situation does need to be settled in some way. And whether they move forward or not, this is an important, especially for our biggest trading partners like Canada, Mexico, and the EU. And I mean, China obviously is one of our top two biggest trade partners, but things, there's a framework agreement there and things are kind of moving along, but those three entities are pretty big for the US are pretty big question marks in our pricing structure. So I think if those get resolved in the next throughout this summer, the chances, based on what I read in those minutes, the chances of seeing some late year rate cuts are a lot higher if those trade deals are resolved.
Okay, so speaking about the tariff discussions, there have been some additional talks around Canada, Mexico, and the EU. Is there more you want to share?
Yeah, this I, I sense that the maybe the president is frustrated that there hasn't been that those particular entities have not gone as far as some of the others have. Some of the Southeast Asia or Great Britain, the that there's more kind of hardball tactics, if you will, in these and very high stakes negotiations. And so while there was an extension, there were many letters that were sent out to different countries, including some of our biggest partners that are still on the table. And basically the idea was that the baseline tariffs on absent in some sort of an agreement with all partners would go from 10% to maybe 15 or 20. And I think that this is, part of that negotiating posture. Like, you feel like people are dragging their feet, they're not coming to an agreement fast enough, then raise the stakes seems to be kind of the negotiating tactic that is most often being utilized here. Um, so it is up in the air, and it seems like it looks to me like the stakes are being raised. And so that it's interesting though to watch. It was kind of a ho-hum reaction in the stock market. Remember earlier when something was announced, you saw these big swings, like crashes one day and way up the next day. Um, they almost seem like immune to it now, the traders, and where you see much more mild movements. And I think, frankly, that has probably given the president a little more confidence to get tougher on some of these negotiations. But ultimately, um, big questions left on the table, and they do tie back into our monetary policy pretty big. So another 30-day extension, and maybe by toward the end of the summer here, I guess we'll see. I do think the extension game is kind of long in the tooth and is not uh, it can't happen too many more times or else it'll become meaningless. So I think probably at the end of the next one, things are really going to come to a head.
All right, so we talked a little bit about Canada in that discussion, but let's talk about it in the scope of tourism. And tourism from Canadians is down quite a bit. How much has it fallen this year?
Yeah, this is so. I've got stats that are the whole country, but Michigan is a big beneficiary of Canadian tourism and very short-term tourism, just over a couple of bridges. But then also longer tour. There's several. It's a very kind of dynamic and integrated type of a relationship. But the volume of Canadians taking road trips into the U.S., so you come in by plane or come in over the bridge or over one of the three bridges, the that has dropped in month by month. Like if you were to look at, let me see, June, for example, was down 33%. Canadian tourism, road trip tourism over bridges, down 33%. And that was June of this year over June of last year. If you look at May of this year over May of the previous year, it was a drop of 38%. So pretty big drops. And there was a 22% decline in air travelers from Canada year over year in June. So that's not cumulative for the whole year, but in these summer months when there's these are pretty active tourism months, especially here in Michigan. There's also been double-digit declines in U.S. tourism to Canada, which I thought was a pretty interesting outcome as well. So you kind of have not those declines were not as big as the Canadian declines to the U.S., but certainly it's hard to imagine what other reason there could be other than the tensions that exist between the countries at the moment.
All right, let's turn back to some happenings here in Michigan. There were some changes for Kellogg. It was acquired by a new organization. The news was announced last week. So, what does that mean for the Michigan operations?
Yeah, Ferrero is the name of the company, and it's an international food company that is located in Italy, has purchased Kellogg. Now, you might recall that's probably good for Kellogg. Is everything that I've read so far is that this is something that will make Kellogg stronger and more viable over the long term. Um, Being, of course, the iconic cereal manufacturer. Their snack division had previously been spun off, and that was the big growth part of the company was spun off and is now headquartered in Chicago. Kellanova it's called. That so moving that part away, that felt like a pretty big loss. And so Kellogg was left with the kind of the original traditional breakfast products. And the and so this purchase is something it probably does make the future of the company better. But it might create some risks for Michigan and Battle Creek in particular, um, if that has an impact on operations and kind of the HQ related operations that are currently in Battle Creek. So far, I mean, the initial reports are that that nothing changes in terms of the functions that are handled there. There's an ownership change, and the rest of it doesn't change. Um, I will say that that's what they always say. So when these sorts of things happen, so I don't think you can really take that to the bank. Doesn't mean it's not true, or doesn't mean it's not true right now, but it does. It certainly creates risks for the high value headquarters type operations when an international company buys a company like this too. So hopefully it Battle Creek remains an important aspect of the company's future. Certainly they are posturing that way, but a new risk on the horizon, certainly.
All right, let's wrap up today's show with a look at election 2026 watch.
Just one development to share with you in this case, and that was there was a name that was kind of on the list on the Republican side. Would she run for governor? Would she run for U.S. Senate? Tudor Dixon, who ran against Governor Whitmer in 2022, and she has taken herself out of both races. Never got in them, but essentially withdrawn her name from speculation and just kind of answered the question. Not going to run for governor, not going to run for U.S. Senate. So um, there aren't too many like big names out there that haven't revealed what their plans were. There are two candidates from self-funding type candidates from 2022 that I have heard are um, are still weighing or considering getting in, and those being Kevin Rinke and Perry Johnson. Neither of them have declared or jumped in the race, but Tudor Dixon certainly a big name that was in all the speculation before as a previous nominee for a major party for governor in 2022, has decided to sit this one out.
All right, that's our show for today. Have a wonderful week, and we will be back here next Monday at 3 o'clock.
Thanks, everybody. See you next week.